All right, so we are going to go ahead and talk about assets. And when must you verify assets? So households with a total combination of assets of 5,000 or more must be verified, and you must verify all household assets. And if it's a combined household greater than or equal to 5,000, you need to verify. And if it's less than, verification is not required, but we do want you to do the sworn statement of net household assets and make sure that it's signed by the resident. If you do verify the assets and it's under 5,000, that's fine. You can send those forms if you want. You don't have to do the sworn statement of net household assets if you do that.
Is there any exception to that, Shona?
Can you go a little more detailed, Michael?
Well, sometimes the people that invested, want a higher standard. But this is our standard, the commission standard.
Yes, this is the commission standard. That is true. Thank you. All right, so assets have a market value and a cash value. The market value is the value of the asset on the open market. So for instance, your checking account. You know you have a balance of a certain amount and you can withdraw that full certain amount. The cash value is the market value minus what it costs to convert the asset to cash. So for instance, if you have a CD or 401k or any kind of investments that to be able to pull any money, you're going to have to pay some kind of fee. So imputed income versus actual income. So if assets are 5,000 or more, you must use the higher of the actual or the imputed income amount. Under 5,000, you use the actual amount earned. So for instance, the actual income would be on your savings account. Say that you get 0.001% interest on what's in your savings account. That would be considered the actual income. Imputed would be that you have the 5,000 there, and we use the imputed amount of 0.0006, I want to say, but that's on the HEC, and it'll actually do it for you. So when you use the HEC form, it calculates out and it figures out which one is more, the actual income or the imputed income, and it'll put it it'll grab the right one and put it in the form properly. So assets that are owned jointly may be prorated. So for instance, if you and your ex-husband, you guys are divorcing, you guys own a savings account, you can, and he doesn't live in the household and he doesn't live in the household and the wife does, you can take that asset and divide it in half. And just having a name on an account does not mean that the account is owned by you. So there are, for instance, when my mother was ill, I put my name on her account, just in case I needed to be able to pay any of her bills or anything, and it's all for her. None of it, I can't take any money out just for myself. So just because my name was on the account doesn't mean that it's my asset. It's really my mother's. So on those joint accounts, you're going to want to find out who receives any income from the asset, meaning the interest rate, or who pays the taxes on the income. And again, in that instance, that would be my mother. It wouldn't have been me. Is there any questions?
There was a question. What if the couple is living on a separate household? How do you calculate the asset?
If they're in a separate household and it's there's two people, we usually say 50-50 is kind of the common. But if you have something that documents it further, if you wanted less than 50, we'd have to be able to have some kind of documentation to prove it. All right. So let's look at some different types of financial accounts. Checking accounts, savings, money markets, CDs, stocks, bonds, mutual funds, foreign financial institutions, or cyber, maybe PayPal, Venmo, Google Pay, Apple Pay, Lending Club, or Bitcoin. And SSI, Social Security, and TANF, they have a cash card or a debit card, and that's considered an asset too. To be able to get, you always would like to get if they go to the bank machine and just get a little receipt showing what the balance is, that can be used to be able to verify that asset. So for the checking account, you want to use a verification of deposit or the most current 6-month bank statement. So if you send in the verification of deposit, the bank itself will put a 6-month average on there, and that's what you're hoping for. I've heard that some banks are not doing that. So then of course you'd want to go and get the 6-month bank statements. We are using, I believe we have varied from that sometimes, because some of the banks are not going for a full 6 months, but definitely double check with your portfolio analyst if you have any questions on that. And if you get the 6-month bank statement, you're going to want to get all of the pages for that bank statement, and you're going to want to look through all of the deposits that are put on there and make sure that those match up with the REA. If there's ever anything that doesn't match up, you're going to want to ask your resident to verify why it's not on there. And the market value and the cash value is the 6-month average balance for the checking account. And the income would be if there was any interest. Some checking accounts do have interest. So the CD, money market, savings, stock, bond, mutual, cyber, you're going to want to still use the verification form, or you can just get a current statement, because the market value and cash value is the current balance of this account. And the income is, again, going to be the interest rate. Is there any questions, Michael?
Well, they noticed that Navy Federal, I think that's a credit union, only gives 2 months in their averages, and different banks and credit unions give different amounts. Is that acceptable?
I know I've heard of 3 months. Anyone else? Eric or Dwayne, have you guys?
I've heard of 3 months too, and I think our standard on that is basically get what you can. You know, if they're only going to give out 2 months, take that and figure out what the average is. Most folks don't have, well, depending on the property, a lot of folks in affordable housing don't have a lot of assets, but some of the senior properties, of course, can.
Right. Well, and especially with bond, I see some bond ones that quite the assets. So, all right. So we will go ahead and move on. Thank you, Michael and Dwayne. All right. So now we're going to talk about 401ks, IRAs, and retirement accounts. So they're always going to be considered an asset unless the household does not have access to the funds. So if they're not able to get it, even if there's going to be a penalty, then you're not going to count that. A household is receiving periodic payments, meaning that they're receiving a monthly check from this asset. Then that monthly amount is going to go up in the income section of because it's going to be income. And so that asset's not going to be counted at the bottom. You're not going to double count it. And if they get a lump sum, say social SSI gives back payments, or you get severance pay, insurance settlements, those you're not going to count. Those are sporadic. They're not periodic. So they will be considered an asset if you put it in your checking account, your savings account, then it will be counted. But if they just go out and spend it, then it's not, you're not going to have to worry about it at all. But you do want to find out what they did with it if it's not in their checking or savings and it doesn't reflect in their assets at all. So you're going to want to verify with appropriate verification form. and you're going to want to get the most current statements. So for instance, for the 6-month bank statements, you're going to want to get the last 6 months. And for the savings account or money market, you're going to want to get the most recent one that they have. All right, and we have a poll. So it says, do I need to count the required minimum distribution, the RMD, on an IRA account as income? So that's going to depend. Is it taken as a lump sum? Then you're not going to count it. It's going to be a one-time shot. If they put it in their checking savings, it'll be an asset. But if it's taken and they spend it, you don't have to worry about it. Periodic payments, they get paid monthly. Yes, you're going to count that. And then you're not going to count the balance as an asset. So it's going to be either or, the income, or it's going to be the asset. Okay. And then there was another question that was on there. How should I round a household's income and or assets during a calculation? So do you round it up, or do you round it down, or do you not know? So I'm going to just let you know, you're going to round it up, and you're going to round, it says per HUD, round only the final total household gross income amount. So for example, Mary Smith, she receives $944.60 per month as a pension. And then she receives $250 in gift income from her daughter. And then from her assets, she receives $150.33 in asset income per year. So you're going to calculate the annual amounts as follows. You're going to take the 944.60 times 12, because it's 12 months, and you're going to come up with the $11,355.20. You're going to take that $250 and you're going to times that times 12, which will be $3,000. And then you're going to add the asset income in there, and you're going to total the gross annual household income, and it's going to be $14,485.53. Because the final total is greater than 50 cents, the final total should be rounded up to $14,486. So we're only going to round up the very last number. All right. Is there any questions on that? Okay.
I had a question in the chat of whether you round 49 down and 50 up. And I responded that yes, but only on the total.
Okay. All right. So now we're going to go to whole life insurance policies. Oops. All right. So for the whole life, you're going to use the cash surrender value. So when you get a copy of the whole life insurance policy, it will show a cash surrender value, and that's the amount that you're going to use. Oops, there we go. And so the income is going to be the guaranteed interest rate or the annual earnings. And then term life insurance, that does not have a cash value, so you're not going to have to worry about that at all. All right, so we're going to jump into annuities. So the market value is the current market value of the annuity. If you get periodic distributions, you're going to consider it income. And if the balance of the account can be withdrawn, it would be an asset. But it's going to be either or. So if they get periodic distribution, you're going to put it up in the income and you're not going to count the balance. Was there any questions about those two? Everyone good? And it was clear as mud, right? Okay. All right, so let's jump into trusts. So there's a lot of different kind of trusts that are out there. We're just going to kind of touch on a basic one. If you have any trust and you get the paperwork and you're still not really sure, you can always reach out to your portfolio analyst and they can muddle through it with you. and try to be able to come up with the best possible answer for you. So a trust is a fiduciary relationship in which one person, the trustee, holds the title to property or assets for the benefit of another person, which is the beneficiary. So for instance, this is all going to be dependent on who is your applicant. So if your applicant was the grantor, they're the ones putting the money in the trust. So you're going to want to look at it that way. If they're the trustee, most of the time they don't really get anything from the trust. But if they're the beneficiary, they may receive benefits. So you've got to figure out which part your resident sits in. So you're also going to want to find out what kind of trust it is. Is it a revocable trust, meaning that it can be changed? Or a non-revocable, meaning that it cannot be changed? So if you get a copy of the legal trust document and you determine whether the household has access to the funds, either as income or as an asset. So again, the grantor, it would be the asset, and the beneficiary would be the income. And assets placed in a non-revocable trust may be a disposed of asset, meaning that if the grantor was your applicant and they put $600 into this trust and then they made it a non-revocable one, that means that once that $600 went into that trust and it got closed, you're going to need to count that as a disposed income or disposed asset of less than fair market value. So you're going to count that for 2 years from the time that it was placed in there. Sorry. Was there any questions on that? I know that was a very brief overview of a trust. They can get real detailed. All right, so we'll move on to real estate. Okay, so real estate owned is considered an asset. And so you want to determine the real estate cash value. Well, for starters, you want to find out what they're doing with the real estate. Are they going to rent it out, or is it being rented out? Or are they going to put it on the market to be sold? You're going to want to find out a little bit more information. So for determining the real estate cash value, you can get the fair market value. You can go online and find it that way. You can go to the county auditor and find out how much they view it as. If it's on the market, that means that there's probably a real estate agent involved. You can ask them for, they can give you the listing to show how much it's going to be put on the market for. Or if it happened to be appraised, you can ask for a copy of the appraisal. You're going to take out their mortgage principal balance only, not the interest, just the principal. So you're going to want to get the most recent mortgage statement to be able to figure that out. Then you're going to minus how much it's going to cost to sell. We usually determine about 10% is about the going rate right now. It might go up or down, but we usually use 10%. And that's going to equal what the asset is as a cash value for that asset. And then you want to use the real estate evaluation worksheet to calculate the cash value from the real estate. And that, that form is going to actually break it out into exactly what this shows, fair market value minus. So it'll be very simple. You don't have to remember all of these pieces because it's on that form. So residents hold a real estate contract mortgage for their real property. So instead of selling it, they just, they sold it to someone who's going to make payments on it. So the real estate contract holder is the individual or entity that owns a real estate loan. So you're going to want to get a copy of the loan contract and the amortization schedule that they've agreed to. And then you're going to take the cash value, and the market value is going to be the principal of the loan at the certification effective date. So you're going to want to look at that and see how much principal is still owed on that loan. And then the asset income is going to be the amount of the interest paid over the next 12 months, according to the amortization schedule. As we all know, the interest changes every month. So you really need to see the amortization schedule to figure that number out. Okay, so now if that real estate, if that house has actually sold in the last 2 years, you're going to want to know that, because you need to know what they did with the money that they got from the sale of the house. So you're going to want to ask for page 3 of the closing disclosure statement. And then you're going to want to look on the seller side to see how much they actually got out of the house. So for instance, this person got $64,414.96. You're going to want to ask the applicant, what did they do with that money? Did they spend it? Did they give some away to maybe their children? Because if they did give anything away to their children, that's going to be an asset disposed of for less than fair market value. So you're going to have to count that for 2 years. If they spent it, then that's fine. And you might even see it in their checking or their savings account. So you're going to want to make sure to document what was done with that cash that was received. Okay, is there any questions on real estate? No questions. All right, so we will move on to assets disposed of for less than fair market value. Like I've been saying quite a bit here. So that is an asset that was sold for less than fair market value, or it was given away or put into a trust. And this may be considered an asset disposed of for less than fair market value. So the cash value at the time of the disposal must be determined. The imputed interest on this amount must be counted towards the household income for 2 years. And again, that's at the time of disposal, not of the time of their recert or their certification, okay? And do not count the asset lost due to bankruptcy, foreclosure, or divorce. All right, is there any more questions? No?
Not seeing anything in chat.
All right. Well, good. I'm glad this is so fun today. All right, so the personal property as an investment. What is included? So jewelry. Now, we're not talking about the costume jewelry. We're talking about, you know, the big diamonds and the gold that you have. Collections such as stamp collections, maybe Star Wars collections, coins, antique vehicles you might have. Ones that are not driven on a daily basis, of course, ones that you only bring out in car shows. And then they must be appraised. So you're going to want to ask for the appraisal for whatever investment that they do have. And what is not included? So their household furniture, the business assets, equipment, television, audio, personal jewelry, stuff that they wear on a daily basis, cars that they drive to and from work, campers, none of that's going to be considered. Your cell phone, yeah, that looks a little dangerous. And household furniture. So you're going to want to obtain the current market value from an appraiser. And the cash value is going to be that market value you got from the appraiser minus whatever it's going to cost to sell it. All right. Okay, so now we're going to talk about, when we say cash on hand, we're talking about significant cash on hand must be disclosed, not the $20 that they have in their wallet. We're talking about the $50,000 that they have underneath their bed. There's
the picture I was thinking of.
Oh, is that your bed there, Dwayne?
No, it's not, but I remember this slide from the fundamentals one. And I wasn't sure if it would be in this one.
Yes. So you must count that.
They don't need to bring that to the office.
Yeah, no, you don't have to bring it in and count it in front of us. That's okay. Just a notarized cash on hand affidavit would be great. All right. So anything about assets? Any questions, clarification? We're all good on this?
Can I share something about notarization?
Sure.
I had an email question this morning that some folks are having trouble finding notary at their bank because the banks are closed to personal entry. And so I just did a quick search and I found, it was over in Kitsap, and I found that UPS stores offer notarization. So you might check there, or just do, just do a quick search online to find local notaries.
That's true. I never thought of that because I know at my bank, I have to call and make an appointment to come in. And that could take a little while. Michael, you have a question?
Well, somebody is asking, is there an amount you recommend for cash on hand? So when do you have to account for that?
I would say maybe over, to be honest, I don't know. I mean, I just think a significant amount, maybe 1,000 or over. Any ideas, you guys? Yeah.
Somebody suggested 500 or more. So
yeah, that could be. Sounds like a good number. Oh, Eric says just a minute.
he's going to check on that.
Oh, okay.
Maybe. It's also, is it expensive to become a notary?
Well,
Or it's
I
not that
became a
expensive?
notary.
Well,
It's a couple $100 a year.
I had to unmute Eric. He's ready now.
Oh,
with the cash on hand, keep in mind that you need to verify any assets that are $5,000 or more for the household. So it's more of a company policy. You don't need to verify anything less than 5,000, but you must verify if it's over 5,000. So keep that in mind when your company is determining what you must verify and what you don't.
right. So if someone's assets are 4,500 and they 600 would be your magic number there.
So such as if they fill out the REA and they say, oh, I have $4,500 in my checking account, are you going to verify that?
Oh,
what's the
but
difference
if they have,
say that,
right.
or
True.
They say, I have 4,500 in cash underneath the bed. Are you going to verify that?
How much
So-
they have in their checking.
Keep
point.
that in
But
mind.
yeah, I agree with the household assets over 5,000. Then you would want to verify that.
But like Shauna was saying, if they had $4,500 in cash, but then they had $1,000 in the bank account, now you're at a point where the household has more than 5,000 and you have to verify both.
So I guess then they have to bring that 4,500 in cash and we all have to count it together. And let's talk about the student rule. So households occupied exclusively by full-time students are not allowed in the bond program. So they must certify the student status annually, and full-time is defined by the institution. So you send off the request to the school and the school will tell you if they're full-time or not. Attending school full-time any day in 5 months out of the calendar year, not necessarily in consecutive order. So for instance, if they just went to school for 1 day out of the month, they just went 1 day, that's going to count for the whole month. And then if they went to school and these are calendar months, so remember that. So if they went to school in January and February, but then they took the time off until the following October, and they did October, November, and December, there's 5 months. So you got to be careful because especially when you're recertifying someone, because you might be looking behind or forward. So you want to make sure to count accordingly. And generally, kindergarten through 12th grade, we consider full-time. And then you're going to want to verify the student status if necessary. And And some of the exceptions are if the household includes a member who receives assistance from Title IV, which is TANF. You want to verify with a copy of the TANF letter. And then if the household includes a member who is or was in foster care, you'll want to verify the foster care paperwork from the appropriate agency, which in Washington State, that's the DSHS. And even if they were in foster care for a couple of weeks, that's still going to count, and it counts forever. So a household contains a member who gets assistance from the Workforce Innovation and Opportunity Act, the WIOA, formerly WIA, or similar programs. So you're going to want to verify that through the educational institution. They'll let you know. And then adults who are married and entitled to file a joint tax return. That doesn't mean that they filed one. It means that they can. So you can verify it with a copy of the tax return if they filed together, or the marriage certificate. And an adult household member, adult household members are single parents with minor children. The adult is not a dependent of any third party, and the children are only claimed by a parent. So you want to verify this with a copy of the tax return, a signed affidavit that the adult in the household is not a dependent of anyone outside of the household, and that the children are claimed by a parent. And you can refer to the IRS code located on the student certification form if you have any other questions on that. And there's a polling question.
We have an international student who attends school full-time but receives 0 credits. Schools generally confirm student status by the number of credit hours taken, so it's possible that the college may verify their status as part-time. Should we consider these students full-time or part-time? Can be a tough question. And these FAQs are real-life situations. We had this happen at one of our properties. We had a new property go in right across the street from an old property, and it seemed all of the students were going to the new property. So I'll go ahead and end this poll here, and then I'll finish my discussion. Looks like most of you said full-time, some with part-time and some with I'm not sure. And yes, the answer is full-time, and this is because student visas specifically require students to attend school full-time to remain in the United States. Households with international students would need to have at least one other household member who is not a full-time student to remain a qualified household. Oh, here are the results, sorry.
Well, it looks like the majority of people chose full-time.
Most people got it, yeah.
Very good.
Very good.
Yeah.
All right. Oops, sorry. There we go. All right, so fair housing. So you may not discriminate in providing housing on the basis of race, sex, national origin, color, religion, disability, or familial status. So properties must also comply with all the requirements of the Violence Against Women Act, VAWA. Okay, and so local requirements, so some local, state, counties, and or cities may have additional considerations, such as the following protected classes: sexual orientation, age, political ideology, marital status, ancestry, creed, parental status, public assistance or Section 8, veteran, military status. You're definitely going to want to get a hold of all of the different requirements from your state, your county. I mean, it's amazing how many you can probably pick up there. But if you're confused or not really sure, you can always contact your local Fair Housing Enforcement Agency for assistance on that. And in the packet that we sent you guys, you'll find the Fair Housing Agencies in Washington State, and you can use that to be able to call around, okay? Okay, so some additional low income set aside commitments. Some of the other lower set asides are 30% AMI, 35, 40, 45, and 50. Now 50 could also be your federal set aside if you're a 20 at 50 property. So, so that could be either or. And the lower income limits may apply. And reminder, the set asides float amongst all units at the property. Now that's a commission rule. It's not a rule that you guys may have a totally different rule. So you, if your guys are set, you might want to, that's probably a management rule. All right, so disabled commitments. All households must complete a disability certification form at move-in. If the property does not have this commitment, do not use the disability certification form. I'm going to repeat this because you want to make sure all households that come in to apply for housing, that everybody fills out this form if you have this commitment. Because if you just start saying, oh, I think this person might need it and this person doesn't, that's a fair housing issue that you don't want to get involved in. Okay.
Shauna, we used to have a slide for this one of a photo of a very well-dressed young man. And I think the thing that goes along with it is you can't tell if someone is disabled just by their appearance, nor should you try and guess that they are disabled or not. It's their choice whether or not they choose to be counted as disabled.
Right. I mean, a person in a wheelchair could come in and say that they're not disabled.
Exactly.
You're going to take whatever they say. You're not going to say, no, hey. So disability means it's a physical or a mental impairment that substantially limits one or more of the major life activities of an individual, such as not being able to care for oneself, performing manual tasks, walking, seeing, hearing, speaking, breathing, or learning. So qualify for the set aside if the household identifies at least one person in the unit meets this definition and have the disability verification. Again, you only need this for, so if there's one person in the household that's the disabled one, that person should fill out the form. We don't need one for every single household member that is living in that household, okay?
Please
We
no.
just, I've received some that nobody was disabled, but I had like 5 different forms. So disability verification form must be signed by an individual with knowledge of the household member's disability. And please don't let your site staff sign that. That could be a fair housing issue later on. You just don't want to go down that aisle. So the person that's living in the household with that person can sign it. I mean, it could be anyone. It could be, if they want to bring it to their doctor, they could do that. You know, I mean, and on mixed use properties, market units can be used to meet the set aside. So for instance, you might only have, you know, you don't have all of the qualified people are not, they don't meet the disabled set aside, but some of the market units do. Everybody in that property, I would have fill out that form when they're moving in. And then that way you can use some of those market units to be able to meet this set aside. And remember, when you're sending in your documentation, this is only filled out at the time of move-in, because once qualified, always qualified with this one. So you have to send it in when they first move in, but the following years, you do not have to send us this form every year or have them fill it out every year. Oh, there, once qualified, always qualified. Okay, so the large family commitment. The definition is 4 or more household members in a 3-bedroom or larger unit. So this is also a once qualified, always qualified. So if the household if a household member from the original 4-person household moves out and now there's only 3 people in that household, this still qualifies. We would like you to please note it somewhere if you're when you're sending in your report. So when we see that there's only 3 people in the household, but yet they're meeting a large family household set aside, if you don't let us know, we'll probably be asking you, how does that household meet this? And as long as there was 4 people at any time, it doesn't matter if it was at move-in or they lived there for 6 months and they moved someone else in and then they met that set aside. It's just as long as 4 people had lived there at some time. And once the household moves to a smaller unit, they're no longer qualified. So of course, that's a smaller unit than 3 bedrooms. So the elderly household commitment. Elderly household definition is 62 or older, and that's all residents. These are federal. 55 or older, at least 1 resident per household. And you should be able to find this in your regulatory agreement, which one they chose. If it's a USDA RD property, we go by theirs, which is 62 or older or disabled at any age. And if this is a HUD property, we do follow the HUD, what's on your HUD contract. So you'll want to look there and see what your set aside is. So certifications must contain the proof of age each year. I know we have once qualified, always qualified for all these other things, but for some reason, we've got to verify their age every year. I know you're not getting any younger. You probably wish you were, but so when someone moves in, you're going to want to take their driver's license and you're going to make a copy of it and make it fairly big so we could be able to read it. Don't make it too dark or too light because every year you're going to have to make a copy of that to be able to send to us. I would keep that, the main copy, in your file. And it doesn't matter if it expires because we just need a copy of how old they are. And that was expired or not, it still works.
And if I could just add to that, I received one year in a certification, a blank sheet of paper with a rectangle, a black rectangle in the middle of it, this big. That was someone's copy of their ID. Please make sure things are legible.
Yes.
If you can't read it, we can't read it.
Right. And that's why it's always good when you do that first one to do that, not too dark, not too light, because now you're going to make a copy of that one every year. And if you can't read that one, that copy isn't going to be any better.
Or they could make multiple copies and put those in the file and then just pull out a copy each year.
That's true too.
Or each year they send them to us.
That's right. All right.
I think we may have, nope, almost a poll question.
Almost. Okay, so the 30-day rule pertains to the state special needs commitments only. So the units must be held vacant and in rent-ready condition for a minimum of 30 days while marketing to targeted populations. So for this one, it would be, for the bond program, it would be disabled and large households. That's what this rule would apply to. So when you're thinking of marketing to that target population, do you have a referral agreement with any different kind of programs out there? You want to market to those set-asides. So large families, you know, you want to definitely, when you're making any kind of in the newspaper or anything like that, you want to note it on there that you have large households or large units for large households, or because you're marketing good faith efforts, they're defined as actively marketing to specific populations in which the special need commitment qualification is necessary to meet for these commitments. So if and a special needs vacancy report is required to be submitted with the annual report if it's applicable. So if you had to, if you ended up renting to another household 30 days after you were trying to rent that set aside, that's when the special needs vacancy report would come into play. And it does not apply to elderly. Now, I'm sorry, but transitional or homeless is not in the bond program. So if you can cross that out on this sheet. Sometimes we use tax credit and bond are pretty much similar, and that got missed when we were doing the bond report. Michael Silber, you had a question?
Well, we had a question about whether an ID needs to be sent with every package.
For the elderly?
Right.
Yes, it does.
If you're required to do research.
Yes, of course. All right. So when must you meet the state special needs commitments? So in new construction, the state commitment must be met by 100% occupancy. I would definitely not be pushing it off, and then all of a sudden your last 4 units you have to rent to that certain set aside. I would definitely try to do it throughout the lease up. In an acquisition rehab, it needs to be met at the 8-month report. And then there's no double counting of commitments. The only one that, yeah, so I mean, this is only disabled and large households. And there's a polling question.
Hey, time for more polling questions. So this is, we've got 3 polls coming up for our state commitments. And number 1, what are considered state set-asides? And this is multiple choice. Have a choice of 30, 40, 45%, 50%, 60%, or unsure. So I'll go ahead and share the results. And looks like got some at 30.
So
Most people-
again, 50
Nobody chose
could,
45. Sorry, Shauna, go ahead.
I was just going to say, just remember that the 50, that could be a federal election as well. So if you're a 20 at 50, then 50 would not be a state set aside.
But
If you're a 40 at
60,
60,
yeah.
you would be a 50, would be a state set aside. Oh, and it looks like you might have another polling question.
Yes. Here comes another one on state commitments. What are the state special needs set aside? This is for Washington State. Okay, so yes, large household, disabled, and elderly.
All right, so it's 11:15 and we're ready to start on recertifications. All right, so all households are required to be recertified during the calendar year. It doesn't have to be by their anniversary date or the date that they moved in. It is a good thing to be able to have a set, if it was me, I would definitely try to do it on a year after they moved in. That way you have a set time of when they need to be recertified. The last thing you really want is all of a sudden it comes December and you realize that nobody's been recertified. Now all of a sudden you have to push and try to get these all certified by 12/31. That would be crazy. That would be a nightmare. So I would highly suggest, if you're not going to do it by the annual research date, maybe, have different times of the year that you do so many people, and have it definitely written out somewhere. You can begin this process up to 120 days prior to the effective date, meaning that also that paperwork is only good for 120 days. So you really want to make sure that if you're going to start it, you really have them recertified by 120 days, or you're going to have to get that paperwork all over again. And you must third-party certify residents every year. Okay, so transfers. So a previously income qualified resident may move to another unit within your project without requalifying under the current income limits. And again, within your project. So if you have multiple buildings, it's within your project, okay? Note that once a resident moves to a new unit, they can only qualify the unit that they're living in. So the unit they vacated cannot be counted towards the project's minimum set aside until it's rented to an income eligible household. So as soon as that person moves from that unit, they're taking their status with them. And that unit all of a sudden becomes almost like a market. So vacant units, they may be counted toward the property's income set aside requirements only if the vacant units were immediately previously rented to a qualified, income qualified household, and the units were not offline for any reason. So for instance, if you were doing any kind of mini rehab or anything and it's offline for more than like say 30 days, then you're not going to be able to consider that a qualified unit anymore. Leasing requirements. So a minimum of 30 days lease needs to be or longer, but it cannot be shorter than 30 days. And the units must be substantially the same size. Appliances, equipment, amenities, square footage as market rate units. And they cannot be geographically separated. And the latest commission bond lease rider must be used. And non-renewal of leases requires good cause. All right, so allowable fees. So customary charges are permissible: damage, cleaning, pet deposit, and credit check fees. Additional paperwork fee is not permissible, meaning if you have to do additional paperwork, you can't charge them for that. First and last month's rent can be charged only if the same is charged charged to non-income qualified residents. Okay, did we get any questions on any of the leasing procedures? So, eviction order. What is good cause? It's serious or repeated violations of material terms of the lease. Example of good cause would be failure to pay rent. All right, so right now we're under rent rent moratorium, or eviction moratorium, and failure to pay rent is that's not good cause right now. And of course, the eviction moratorium also depends on when it's going to expire, depends on where you live. So the governor has set one for the state of Washington, and I believe the CDC did it for the United States, but also cities and counties could have those as well. Oh, criminal activity. Check your local jurisdiction, and fraud and false statements. So if they try to come in and not tell you about all of the money that they have so that they could income qualify, that would be a false statement. So in a property, when a household's income goes over 140% of the current qualifying income limit, when recertified, they become over income. The over income unit can continue to be in compliance as long as the next available unit of equal or smaller size is rented to a qualified applicant. So meaning that when you're ready to rent to a market unit, make sure you don't have 140% unit there. And if so, you want to make sure that you're renting that market unit to equal or smaller size, or you could be out of compliance. And when a market, here it is. When a market unit comes available, make sure there are no households over 140% before re-renting a market unit. So let's give you an example. So this is big Seattle apartments. There's 10 units. They're all the same size. There's one building. There's 8 units at 60, and then there's 2 market rate units. So as you can see, the 2 market rates are right here and right here. One on the first floor, one on the second. And so all of a sudden, the 60% unit on the top floor over here goes over 140%. Then this market rate unit, they move out. So now what you can do is you can change that market unit, because now it's a vacant. You can rent it to a 60% household, income qualify them, move them in. Now you met your set aside. So you can take that 140% unit and make them a market rate now. All right. This is the next available unit rule. This is really important. And this is for your project. And now there's a poll question.
Annual reports are due by January 7th, June 30th, March 30th, or January 31st. So bond annual reports are due by January 7th every year.
Tax credit ones are due January 31st. So if you have tax credit units, that's probably why you might have thought January 31st.
True. Okay. So
And June 30th, if you have usually the table 4 is due if you have W bars. So maybe that's why someone got confused there.
yeah, and the 8703s, I believe, are due March
yes.
30th.
That's true.
Okay. So we have one more.
Oh.
And I verified that I did set this one up correctly as a multiple choice. Which of the following documents are important for maintaining compliance? You have your regulatory agreement, your 8703, your lease rider, and your management agreement. Okay, so
Technology.
the very important documents that we recommend you be familiar with are, of course, your regulatory agreement. You want to have a copy of that so you know what's what. And then the 8703 is the other one. Of course, the lease rider and management agreement are important to have. But maybe I should revise this question to make it more clear.
Yeah, because I would think as a management manager, you would be thinking all of those are important.
Exactly,
So.
yeah.
Required and when. So the annual reports, the bond annual reports, they consist of the Certificate of Continuing Project Compliance. We call it the CCPC, and it's Part A, and that must have the original signature of the owner. So if you make a copy, you'll want to keep the copy, and the original should be sent in. The tenant activity, which is the CCPC Part B, it's an Excel spreadsheet of Table 1 that's submitted. That's if you have W bars. A lot of bond, they don't use W bars, only if they happen to be in there for something else. So then the affirmative marketing report and the special needs vacancy report and all the household certifications that are on that request, those are all due on January 7th. And when I say due, that they need to be mailed into our office by January 7th. And the 8703, that, if that's applicable to your property, that's due on, actually that's due March 31st. I think we said June 30th just a minute ago, but it's actually March 31st, the first quarter. That's when it gets sent to the IRS, I believe. And then I believe we send out a request after that. All right, so now we are going to take a look at the Part A and the Part B we were just talking about for the annual report. And all right, so here is a copy of the letter that's going to be sent out to the owners. This usually gets sent out in December, and it talks about what the period is. So this is going to be for January 1st, 2020 through December 31st, 2020. It's due on January 7th of 2021. And then this talks about where it needs to be mailed and some other information. Down here, this is the report checklist. So you're going to be sending the report in with the part A and then the part B. And then you're going to send documentation for all qualified residents. And that's going to include new move-ins and those that transferred units and those required to recertify annually. These are the documents that we want that need to be sent in with it. Please do us a favor and put these in this order. It is so nice to be able to look through a file and have it in a specific order, okay? So it's our HEC, the REA, the income verification documentation, and I think we sent you in the forms all the different versions or different ways of income verification information. And then verification of assets or the sworn statement of the net household assets if it's under $5,000, and that's optional. At the disabled status certification, and that's for people who have disabled set-asides only, the disabled commitment. And also that's only going to be for when they move in. For their research, they're not going to fill that out, so we don't want a copy of that. And then that's the same with the disability verification. And then the student certification, for projects using HUD, you can use form, oh, okay, this should have been somewhere else. So the student certification, that question is also answered on the REA. They could check yes or no. I always try to suggest everyone have their residents fill out the student certification. That way there's no questions asked. It's because it goes into detail on that questionnaire. And so it's a little more specific, but it's not required. If it's answered on the REA, then that's suffice for us. So projects that have HUD or RD, we can use those forms in place of our HEC and our REA. And then the age verification for the elderly designated projects. Like we said, we want a copy of that driver's license or whatever they're using to be able to verify their age. And I believe we sent you in your documentation, we did send you some other information on the verification that's acceptable for us. And then the special needs vacancy report, if that's applicable, we do want that sent in with any of the backup documentation. The affirmative marketing report, again, if it's applicable. And to find out if your project is required to complete this, you can go to this website and see if your property name is on there. And if you've got a Section 8 renewal attached with your property and you did a renewal, we'd like a copy of that. And if you don't worry about it. It's only if it's applicable. And then you're going to mail all of those to us here at the commission. That gives our name, or our address, excuse me. So here's a copy of the bond part A. So the top part just is about the property itself. And then you come down here, and this is going to be sent out, and it's going to be filled out pretty much for you of what we have on file. So you're going to give us what is currently happening as of 12/31/20. Okay, so here it tells you how many units you have in the project, and then right here shows you how many set aside units you have, and then down below it's going to tell you the AMI, how many per AMI. So for instance, this one has 5 set aside units, and all 5 of those are at 50%. So over here, you're going to tell us how many you have. All right. And then this shows how many market rate units you have. And then the total number of units occupied by initially qualified residents with incomes of excess of 140% of the applicable income limits at recertification. So you'll let us know that as well. And then that way we know that you guys are following the 140% rule. Down here, this talks about the special needs. Again, we're going to give you what we have on file. So for instance, this property has 11 disabled units. As you can see, they only need to meet 5 set-asides, but they have 11 units. So 6 of those units are more than likely going to be obviously market units. So again, make sure that when everybody moves in that they fill out that disability form if you have this set aside. And then there's some questions that need to be answered. And then number 9, I'm just going to kind of go into detail on this one, because on number 9, we want to know what the unit numbers are that are qualified vacant. Not how many units you have, but what unit numbers they are. Okay. Oh, yes, Dwayne.
Shauna, a good reminder for folks, if you go back up to page 1, so this property is required to have 5 units set aside at 50%. It can have more than that.
Oh,
I
yes.
often recommend that properties have additional qualified units just in case there's something with one of the certifications that doesn't allow them to be counted.
Right. And when you get 140% unit that comes up, it's a good thing, because if you have someone else, you don't have to count that person and you don't have to follow that rule, which is a very good point. Thank you, Dwayne.
Sure.
All right, so pretty much there's, the owner then goes through and answers all of these questions, and then they print their name here, and then they print it one more time, what their title is, and then they sign and date it. And then remember that the original comes to us here at the commission.
Blue ink, please.
Oh, that's a good point. Blue ink would be good. Is there any questions on this at all? Any clarification? Okay, well, we will go to the part B. This is the spreadsheet that needs to be filled out. So I'm going to, view, and we're going to just do 100%. Can you guys see that okay? Okay, so I'm going to guess that means it's okay. So the top part is about the property, when the annual report is, what this annual report is for, the dates for it, who prepared it, their email address, because if we have any questions, we can reach out to that person. A lot of times we reach out to the portfolio or the person we have on file, but if that person's not available, we can always reach out to this person as well. And then what date that they filled it out. And this talks about the total special needs set aside, if it's applicable. This would be large household, and this is disability. And then over here, this shows the number of set aside units at the end of the reporting period. Not what's required. This is how many units you actually have. All right. So like Dwayne said, if it was required only 5, but yet they have 11, well, then they're in good standings, right? If anything happens, they have enough to be able to back it up to meet their set asides. All right, so what you're going to do is you're going to want to pull last year's report, and you're going to want to use last year's report to start for this year. That way it has all the people's information on it. You're just going to tweak it a little bit, okay? So you're going to want to go in there, and of course you're going to update what the annual report dates are. First of all, save it as this year. You don't want to accidentally override last year's. So so go ahead and do that. So what we require is that when you look at last year's, you want to go through here and you're going to delete all of the move outs, okay? Because they moved out last year, and so you're going to want to delete them. This report that we're looking at right now, I know this is after everything's been done, okay? I don't have time to actually walk you guys through how to update and change all the reports. So this is the final product. So what I did was I went in and I deleted everyone that moved out in 2019. And then basically then I had a nice clean report. Now the vacant, if there was any qualified vacant units, I want to make sure that that unit was rented. For some weird reason, if it wasn't rented throughout the year, you don't want to delete that one because that's still a qualified vacant, okay? Hopefully you didn't have a unit vacant throughout the year, but if it did happen. So you're gonna delete all the move outs, and then you're gonna go through and you're gonna start entering all the recert dates for all the households. And then if someone didn't recertify and they moved out, you're going to want to write that in here as well. And again, the research can be done at any time during the year. But as you can see, this one, it looks like it kind of stayed true to when they first moved in, their move-in date. And then you're going to do the move out. And when you do the move out, you're going to want to give us an idea of what happened to that unit. So for instance, I put on here that unit 223, they moved out and a market unit moved in. That market unit didn't have a disabled set aside, so I just wrote market in there. But when you look up here at 217, this household moved out on 8/1/2020. And someone moved in on 9/12/20. But as you can see over here, none of this information is filled out. So that tells me it's a market unit, but it meets the disabled set aside. So they're using this unit as a disabled set aside. So in that case, we would want their name to be put here, because when you send us in the disabled set aside, we're going to want to match up the name and the unit number. Okay. And for instance, this household here, when you do insert a line, so I'm just going to show you here real quick. If I insert a line right here, and this status does not pull down. So you're going to want to take this, because this is it's a formula. So you're going to want to take this and drag it down, and then that way it will follow the formula. So for instance, then when I type in any like 38,750, like it says up there, it's going to automatically say yes. If I didn't drag that down, it wouldn't have filled that in, okay? And that's a very nice thing to have. So I'm just going to oops, we'll go back. All right, and so for this household here at 100, this means that this household is now over 140%. So you're going to want, that's when you're going to want to make sure that no other household market unit moves in after this household, because you want to keep this person as qualified. But if you happen to have enough qualified households, you know, you'll do the math. You'll be able to figure it out. So in this spreadsheet, it shows, I'm sorry, I didn't go over the very beginning. It shows the unit number, what the resident name is, their move-in date, their recert date, their move-out date. If the unit was a qualified vacant unit, if it met a special needs set aside, so this would be large family or disabled, what AMI percentage they are. If you have mixed, that would be mixed. Obviously, this is all just 50%. What household size they are, because you're going to need to know what size household it is to be able to figure out what their income, their maximum income level is. So then, of course, you're going to go to our website and find out what the maximum annual household income is. And then this is what their current gross income is. This is what you just recertified them at or certified them at. And if this is higher than this amount, like this one is, it'll pop up right here. This is the over 140%. And so when it does that, you're going to have to follow the 140% rule. This is number of bedrooms, resident rent, and rent subsidy. I know we don't monitor for that, but we do want that information in here. So if you have a move in, you'll just want to highlight underneath where it, because you're going to want to put it in order. So say unit 104 just moved in. I'm going to highlight the entire row. I'm going to insert a column. My first thing, I'm going to come over here to the 140% because I want to drag that formula and I want it to be in the new column. And then you're going to enter in their information. Now, if a household moved out, if a household moved out and a market moved in, it's nice for us to be able to know that. So for instance, this household moved out. Now, oops, wrong one, sorry. Here it is. So this household moved out on 8/7/20 and a market rate unit moved in on 8/31. They didn't meet a set aside, so we don't really need to keep them here, but we want to let your portfolio analyst know that this is what happened to this unit. Now it's a market rate unit. Next year, it's going to be just taken off the report altogether. Okay. I believe I touched everything on this. Has there been any questions that have come in? No? All right. So we will go ahead and exit out of that and continue on. Okay, so the annual reporting, certification packet submission. So do not submit the demographics nor the checklist form with the certification packages. The demographics that can go in the file, and same with the checklist if you want to keep that, or you can just toss it, whichever one. But it's always nice to follow that checklist to be able to make sure you're putting it all in a nice order for us. So you want to assemble and submit in checklist order. Okay, I guess I can say that a few times for you guys, okay? And you do not want to include any extra pages such as the screening application, credit report, the HUD medical expenses, the lease or the lease rider. We don't want any extra pages. We don't use them. So it's just, you're just killing extra trees. Please don't use paper clips or binder clips. Please put a staple up in the left-hand corner of the file. They all go on the top of our filing cabinets. And if they accidentally get knocked over or anything and those paper clips come off, could you imagine the lovely mess we have that we have to now sort and put all into order? So that's why we make sure that this is announced. Okay, so annual reporting for on-site inspections. So the certification forms, okay, this doesn't have anything to do with on-site inspections, sorry. The certification forms for RD or HUD properties, we can use the 3560-8 for RD, and HUD we can do the 50058 or the 50059 in place of the REA and the HEC. That's if the property has rural development and HUD funding. So the following documents are required in addition to these forms. So we want an income and asset questionnaire. If they don't have one, you can use our REA. Verification of income, the verifications of assets or the sworn statement of net household assets, the student certification, special needs set aside forms for just the disabled unit, and the large large household. I'm not, so you can cross out the homeless and farm workers. Sorry about that. And then the proof of age, if it's a elderly property. Please do not send the EIV reports. We are not approved to receive those. So if you do use EIV, you're going to have to do the old-fashioned verification of incomes for us, because we can't use that form. So some of the most common mistakes, submitting the reports late after January 7th. Submitting insufficient or incorrect documentation. Failure to meet the income set-aside requirements. So please, when you're doing your Part B, you saw that some of them were highlighted, the AMIs. Those were highlighted because that's what we do when we get it. We want to see which ones are going towards the set-aside. Please make sure to follow it and make sure that you actually have enough qualified households. And counting non-qualified vacant units toward the income set-asides. So for instance, you go, oh, well, that's just a vacant unit. You really have to see who was living in there first. Was it a market rate tenant or was it qualified? If it's a market rate, it's not a qualified vacant. So failure to follow the next available unit rule. That's pretty big because as you saw, it has to be, a market rate unit has to be rented to the same size or smaller, or you're out of compliance. And failure to rent market rate and qualified units proportionately during the lease up of a newly constructed property. And Dwayne, there is another poll.
We have a poll question. How long should first year documentation be retained? 3 years, 7 years, 21 years, or for the term of the reg agreement?
Actually, it is the term of the regulatory agreement.
Oh, it is?
Yeah, 21 years is the tax credit.
Oh.
Yeah. Remember
That's
15
where I
years?
stole this poll question.
So yay, everyone, the 11 people that did it correctly.
Awesome.
Sorry.
Congratulations. If I can just elaborate on the first year documentation, you need to store those in a very, very safe place. And if you make electronic copies, be sure that you can duplicate or replicate those with, constantly changing technology. You want to be sure you're going to be able to reproduce those.
Yeah,
and my favorite.
Oh,
pardon me?
Go ahead. Go ahead.
Oh, my favorite story that goes along with document retention is from Steve Rosenblatt. He's a nationally recognized tax credit trainer guy. And back in, I believe it was the 90s, someone had all of their documentation stored on the 6th floor of a building. Seems like it would be pretty safe. The Missouri River flooded and washed them away. So
Yes.
just keep that in mind when you're storing things.
Yeah. I was also going to say when you said the different kinds of, because technology is constantly changing. And if you had a property back in the 80s, you might have it on floppy disks. Good luck on getting that information off of there.
Yeah. Yeah.
So that's a very true point, is making sure whatever documentation you're saving it on is something that stays up with technology. So some of the consequences of uncorrected non-compliance is bonds losing the tax exempt status retroactively, meaning that all of a sudden they become taxable, and that I'm sure that the owner's not going to be so happy with that. Significant financial impact on the project and the owner. And owners being barred from further financing with the commission, especially if we see it over and over again. Okay, so property transfers. So the owner may not sell or transfer its interest in a bond property without the commission's prior written consent. So please go to the bond compliance manual to find out about transfers. Oh, refer to Chapter 5 of the Commission's Bond Compliance Procedure Manual for explicit instructions. And that does take a while too. It's not something that you can send us one day and expect us to approve in a day or two. It sometimes takes a little bit longer than that. And this includes changes to the general partner or the managing member of the ownership. And there you, if you click on that link, you can get to the Chapter 5 of the bond manual. Okay, so document retention, I know we just discussed this a little bit, but all original forms of documentation should be kept by the owner or a manager, and copies should be sent to the commission. We don't want the originals of the resident files. These forms should be retained for the duration of the regulatory agreement and are subject to audit by the IRS and regulatory agreement defined, monitor, and the commission. So the retention period noted above is the same for 4% tax credit properties, that's tax credits with bonds, as it is for the bond-only properties. And it may be retained electronically, but must be reproducible per the IRS guidelines. All right, so guess what? That concludes our presentation. So if you guys have any questions, Dwayne, can you go ahead and put the unmute?
Oh, sure.
And if anyone has a question, please raise your hand. And when we call on you, you can unmute yourself and ask the question.
I put it in the chat, but since we're doing this, it's probably quicker. As far as the demographic sheet goes, we've been consistently submitting it every year for research and the like, but you just said you didn't want those. My question is, should we still submit them if there's a household change that would reflect on the demographic form?
No.
Okay.
No, we don't want that form. That form is just to be put in the file.
Okay, so okay. So we still need to fill them out. It just doesn't
Yes.
get sent to you.
Exactly.
All right, fantastic.